Ladies and gentlemen, boys and girls, welcome to FinFluential Media. What a crazy week it has been. We had ups, we had downs, but we finished the week on a very, very sour note. We're going to talk about why. We're going to talk about why we sold off and what are the consequences of that. We all know why, actually. It has to do with tariffs, and we are starting to see retaliation from places like Europe. But we're going to talk about that. We're going to talk about Elon Musk's big moves and what I think is going to do next. And then we're going to have a look at the market. Is it undervalued? Is it overvalued? And should you buy the dip? And where is the best place for you to go ahead and put your money? But before we dive in, if you guys could please go ahead, like and subscribe. It really, really helps me out. But let's dive in, guys. So we had a pretty brutal Friday. It was pretty brutal. You could see that defensive sectors really outperformed. Healthcare, staples, utilities were in the green. The rest of the market, brutal action. For example, look at software, look at tech equipment, hardware, down 2.24 and 2.92% respectively across the board, selling in value, growth, mega caps, high beta, financials. Even AT&T, a telecom generally considered defensive, was down 0.07%. And it all stemmed off Trump's tariffs, the weaker economic data, and the market trying to find its footing in very uncertain times. Now, Europe came out and said that they will retaliate against Donald Trump's escalating trade war by focusing on US services exports. Potential targets include major American tech firms such as Amazon Web Services, Netflix, Microsoft, Apple, Google, Meta. These actions could restrict their access to EU markets and curb their IP. Now, directly restricting access to the EU market, that's obviously going to affect top line, undoubtedly. But, if they are going to add a tariff onto these companies, right? I mean, they're just going to pass the cost directly onto their customers because these are wide moat companies, right? They're B2B operators mostly, except for Netflix. And, their wide moats allow them the pricing power and the advantage of that. Whereas car manufacturers, we saw with BMW, they can increase prices a little bit for sure, but they won't be able to fully pass on that cost without really affecting their market share. Whereas I don't think this is the case with Amazon Web Services, Microsoft. Maybe Apple's a little bit different, but like Google and Meta, right? These are very entrenched services that just have wide moats and have immense pricing power. So I don't think it's a big concern, but Europe is doing what they can. And obviously the US's biggest export are these services from these tech giants, and Europe is going to act in their best interest. Now, Donald Trump is open to deals. He said he's willing to make deals on tariffs, and deals on averting auto tariffs would come later. I don't know what later is. Is it later this week, later this month? But we are in the thick of it. Tariffs are here. Deals can be made, and hopefully we will get some deals into the weekend. We'll see how we go. We're going to talk about it a lot in the live stream. So if you don't follow me already, go ahead, follow, like, and subscribe, especially FinFluential Television. That is where the live streams will be at, especially on my Twitter channel as well, FinFluential X. Now, let's talk about Elon Musk. He has made some major moves. XAI has acquired X in an all-stock deal. The deal values XAI at $80 billion. So now we have X and XAI in one entity. They're not separate entities at $80 billion. And here is a live image of Elon Musk making the deal with XAI and X. Congratulations to all involved. Now, I think there was a couple of reasons to this. There were probably some investors in X that probably wanted to get out. They probably didn't want to hold X as a whole. So it was imperative that this happened to avoid any internal conflict. And I think Musk actually might plan an IPO just to get further funding to build out the AI data. So that way he has two forms of funding, debt funding, right, as well as the capital markets. But we'll see how we go. You may want to keep X in-house, but he can also do like a dual listing structure. But all in all, XAI now owns X. They are a single entity, and that probably allows Elon Musk to have more flexibility with how he can integrate the two and how they can work together. Now, let's actually talk about the market as a whole, guys. Now, according to Morningstar, and this is from an article from Morningstar, the US equity market is trading at about 5% below their estimate of fair value. So this is where you want to start deploying capital into stuff like the S&P 500, the NASDAQ 100. Almost all sectors and size segments are looking attractive. Large cap growth and mid-cap growth are trading still above their estimate of fair value, but there's definitely some great deals to be had in the market, in the large cap space, in the small cap space, value, growth, and core across the board. So this is the time when we have these pullbacks, when we have this uncertainty. This is when you want to start deploying capital for the very long term. Globally, things are looking very, very mixed as well. Europe is looking cheap. Asia, Russia is looking cheap as well. But North America looking a little bit expensive, both Canada and the US. South America looking largely attractive, but then Australia also looking overvalued. So all in all, it does look like globally we are seeing a market that's trading at fair value. Some would say slightly under fair value. And that's really, really good for longer term investors. Now, value stocks and small cap stocks, this is value, this is small cap stocks, continue to trade at a deep discount relative to the broad market. And by capitalization, Morningstar advocate for investors to be overweight small cap stocks, which trade at an 18% discount to fair value, and be underweight large cap and mid cap stocks, both of which trade at about a 5% discount to fair value. Now, historically, small caps have performed best when the Fed is easing monetary policy and longer term interest rates are falling and the economy is poised to begin to rebound. That does not appear to be the case in the near term right now. And while these stocks are undervalued, it may not be until later this year that they actually start to work. So we still have to get through all of this uncertainty. From a monetary policy point of view, the economics team from Morningstar Wealth Management expect the Fed will cut the federal funds rate 3 times this year, while they forecast the rate of growth will slow sequentially through the year. So GDP growth will slow, but the Fed is going to cut rates, and that could reinvigorate the economy. Nonetheless, small caps is what Morningstar say you should be overweight, but they still say hold large caps and mid caps, just be underweight them in your portfolio. Now, looking at return drivers for this year, guys, the mega caps have led the selling lower. For example, this is a year-to-date contribution to the S&P 500's return. Apple has seen the S&P 500 fall 0.84%, Tesla 0.7%, Nvidia has removed 0.68% from the S&P 500. These stocks are down 11%, 31%, and 10% year to date. Google about half a percentage point along with Microsoft, and it is down 11 and 6%. Every single one of these large cap stocks is down year to date, and they all pertain very strongly to the tech and AI theme. Now, since DeepSeek, most AI stocks have seen a pretty severe correction, but are starting to look very attractive. For example, look at Amazon, right? It peaked at $235. It's now at $200 a share. That's a 14% move peak to trough. It is now trading at 4 stars, which is very, very attractive on Morningstar's scale. And you can see a number of these stocks are getting to attractive levels. Apple went from 2 stars to 3 stars. Meta went from 3 stars to 4 stars. Google in that 4-star range, very interesting. Taiwan Semi, a 5-star stock, down 21% year to date. Absolutely crazy. But not everything is made equal. ARM is still a 1-star stock despite falling 30%. So it really goes to show how overvalued this name is. But there's definitely some value to be found, especially in the mega cap stocks. And these are the stocks you want to own for the very long term. Now, Morningstar see value across almost the entire range of wide moat rated stocks, except for growth. Even there, growth now only trades at a 1% premium, whereas at the start of the year, it traded at a 17% premium. Now is a good time, guys, to scour your portfolio and increase the quality of your stock holdings by swapping into stocks or companies with wide economic moats. Not only are wide moat stocks trading at attractive margins of safety below their intrinsic value, but I also think they should have less downside risk because a lot of that downside risk has been priced in. I mean, if you actually look at some of these stocks, Nvidia down 20%, a lot of them in a bear market, Broadcom down 26%, Taiwan Semi down 20%, Oracle down 20%, Salesforce down 15%, right? So we've seen a lot of these stocks move down a lot, and we are probably closer to a bottom in a lot of these names than we are to a top. I mean, is Nvidia going to fall another 20% from here? I don't think so. I really don't think that's the case. It could, but I don't think that's the case. It's time for you guys to start deploying capital. Looking at sectors as a whole, we can see stuff like the communications sector, right? Energy and technology trade under fair value. Sectors that look overvalued is stuff like utilities, consumer defensives, financials as well. But, the broad market actually looking relatively attractive. And yeah, deals to be had in communications, in technology, in energy, in communications especially, right? A big weight is Google and Meta. So those stocks are trading under fair value. And if we actually go back here, we look at Google, right? Trading it's a 4-star rated stock. We look at Meta, it's also a 4-star rated stock. So it might even just be that you just buy the communications sector and call it a day. You get a bit of offense, you get a bit of defense in there, and sit back, and sit through the volatility, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.